We're beginning with covering how do we sit down and assess the market? What do we even do when we sit down at our trading desk each day? I mean, how do we even begin? And unfortunately, I hate to say this, but it is going to look very different for every trader, depending on your personality, what pairs a trader is trading, and even what type of strategy they're trading can change all of this. Let's take fundamentals, for instance. My husband is way more into fundamentals or looking at upcoming news releases than I am. And he begins his day first off with that every day. In the beginning, I looked at fundamentals a little more than I do now, but as I dialed in my core strategy over time, I discovered that I typically only stay out of the market around one news release per month, which is the non-farm payrolls, and it's the first Friday of every month. And other than that, I just kind of have an overview each week or month of what's coming out. And so fundamentals don't really play a role in my day-to-day assessment at all. What type of strategy you choose and what your back testing reveals will show you if your strategy is susceptible to news spikes or not. So market assessment basically means your routine or procedure written in your trading plan that you go through each day to determine which pair or pairs you're going to be looking at for that day. If you're looking for buys, if you're looking for sells, if that pair is even close to an entry signal for you, or if that pair might be stuck in a range, or there's some other reason you might not want to be entering the market for that trading day. And what a lot of new traders don't realize is that it is sometimes more important to learn when to stay out of the market than to desperately look for entries in the market. And so having a routine for market assessment and bias in place really helps you dial that in. And so it's very important. And let's just quickly run down some of the common tools that people use in making their assessment or setting their bias. Let's look at the list here and run down just some of the common tools that people use in making their assessment or in setting their bias. First, we have here fundamentals. Looking at fundamentals includes global market conditions, politics, and economic indicators and reports. You can use the Forex factory calendar as a main source of news, filtering really like only to see the red and possibly the orange releases. And I will have an updated list in the resources section of the website of this course of my favorite news websites and of any of them that John uses every day if that changes. But do yourself a favor and don't follow news outlets, Forex Twitter, or Forex news websites for your news. Seriously, if your technical analysis is on point, you can pretty much, in my opinion, place fundamentals to the side other than knowing when huge news events are rolling out. You don't want to trade during major elections or obvious times to stay out of currency trades, but you also do not have to trace or follow all news events. Again, in my opinion and my experience. We also have higher time frame structure here, and this is simply looking at a higher time frame than your trading time frame or your entry time frame and studying if the market is putting in higher lows or lower lows, and from there determining if you're going to be looking for buys or sells based on what this raw price action information shows you on a higher time frame. Because as we've already gone over, you can be bullish on a higher time frame, but you can be seeing bearish structure on a lower time frame. And so part of the assessment is knowing, what is happening on the higher time frame and what is happening on your trading or entry time frame, and if they're matched or if they're different, and what your rules say about that. We also have volume in the market, and that's considered a common observational tool. Is the pair moving? Is it stuck in a very small range with small candles? Is it trending with large candles? Is it moving well? Is it printing clear structure? people can visually look overall at the volume that a pair is showing versus how that pair normally moves, and they can make determinations off that, or it can be absolutely, done with indicators and other things. There's also intermarket analysis, and it's another tool that's commonly used. Pretty cool. For example, if you're trading a Canadian dollar pair, you might look at the price of oil to see if the Canadian dollar is set to get stronger as the price of oil pushes higher. If you're trading a pair with the US dollar, you might take a look at the dollar index to see if price is pushing higher or falling. You could take a look at the yen basket if you're trading yen pairs, and there are so many other commodities and other market examples that the price of Forex pairs are reflected to the positive or negative in, and that they sometimes can be used to determine what your market might be, or to add weight to what your market bias might be at that moment. We look at correlating Forex pairs, and those are currency pairs that tend to either move in the same direction as each other, or could move almost perfectly in opposition to one another. It can be really fascinating to study some of the correlating pairs. So confluence or validation of your bias, depending on what your testing shows you, can sometimes be found with correlating Forex pairs. Knowing what banks are currently active and what pair is being influenced at that moment can really be a powerful tool in your assessment, especially if you aren't trading at the exact same time every day. Now, remember that all of this information is actually written for you in the handbook if you have that, and is available on the course. But I wanted to give you a quick cheat sheet on the high volume times of the market, as well as what major banks are open and active during which sessions. You want to choose a pair that only has one influencing bank at a time, and preferably an active bank during your trading session. This can be a powerful ally in determining what your main trading pairs would be, as well as the time that you might try to sit down and trade the market. We look here that you can look at high volume times of market movement. The high volume times you have, and this is Eastern Standard Time, pre-London session is 1:30 a.m. to 3 a.m. You've got volume then. The London Open is 3 a.m. to 4:30. You have about an hour and a half there that you've got some push in the market. Pre-New York, and John and I both trade pre-New York. The New York London close is 8 a.m. to 11 a.m. here. Pre-Asian from 6 p.m. to 8 p.m. And a lot of people that have, that work full time during the day, they'll trade pre-Asian and Asian session in the evening from 8 to 10. And the markets are always open, so they don't just close. It's just saying that those times tend to have higher volume and market movement. And so that really helps you when you are looking for momentum and movement in the market versus a time where during that session, where the market movement may kind of just stall out. And just in looking at which banks are active during your Asian session, you have the yen, the New Zealand dollar, and the Aussie dollar. During London, your influencing pair is the euro, the pound, and the franc. And during your New York session, you have the US dollar, the Canadian dollar, and gold. Like I said, if you have the handbook or you're in the course, you have all of that. You don't have to worry about it. It's in there. But I did want to give it to you, just to remind you that definitely a market assessment tool that is common is what banks are currently active and what pair is being influenced in the pair that you're trading. Indicators are another way to establish if a pair meets your criteria for a possible entry or not. As we covered in the indicators section, usually you will have one indicator, which is your baseline, that calls if you're looking for buys or sells, or if you're able to even look at a possible entry or not. Heat maps can be a type of indicator, as well as there's some entire sites dedicated just to mapping out the movement of different pairs and currencies in the market. And they show you where there is strong movement, short or long with a pair. And if you have a strategy that agrees with the heat maps, you may choose to incorporate checking the maps each morning to see what they are showing and if it is in agreement with your chart analysis as to if you're looking for buys or sells. And finally, there is multi-time frame analysis, and that I tend to have in almost all my strategies, and that is that there are always more than one time frame. And each time frame absolutely has its own personalized task. Here's an example that I currently use in my plan. I have a set time frame that chooses if I am looking for buys or sells, another time frame where I am drawing my zones or levels on, and which are ultimately my entry points. And I have an entry time frame, which will be the lowest and fastest time frame that I track what price action is doing and have the immediate view if price starts to form structure in my direction and I get signaled into an entry. In doing multi-time frame analysis, your analysis of buys or sells or viability, meaning if a pair is trending or consolidating, has to agree on every time frame. If you see buys on the daily, sells on the 4-hour, and buys on the hourly, you might have in your rules that you're more profitable if you do not consider any signal valid until structure has flipped to buys in every time frame. So I always have, multi-time frame analysis almost in, I can't even think of one strategy I have that doesn't use on some level in some way multi-time frame analysis. So here's how you take all of these possibilities here and apply them to your trading day. In sitting down every day, the first thing that you want to do is either pull up your watch list or establish your watch list. These are a list of either the pairs that you trade as a whole or the pairs that you are watching because they're looking like they are possibly setting up for a nice trade entry. In looking at your pairs, you might use one or several of the tools, that we just went over to decide if a pair is behaving in a way that you found conducive to a high probability trade setup happening. Once you have your watch list set up, then you want to review for any news releases or anything that is scheduled to come out that could cause massive spikes in the market that you would choose to stay out of. Once you've determined what pairs you're looking at and that your trading day is clear, that you don't have any, previously known or previously established volatile periods, then you're looking at doing a higher time frame analysis. Okay. Now we're pulling in some confluences and we're pulling in some other tools, and those tools could be indicators using structure, a heat map, etc., that will tell you if you're going to be looking for buys or selling opportunities. You want as many pieces, as many tools to agree with that bias and that analysis as possible. Currently, I just start my trading day here at the higher time frame analysis. This is my first step. And since I trade usually only a couple pairs at a time, I just look at where the market moved during the night in relation to where I had my zones and my bias already marked from the day before. I then mark up any new zones or areas of interest and move on to looking for setups and entries from there and waiting for that green light for trade entry. But please don't look past this part. Learning when to stay out of the market, like I've said multiple times, is more important sometimes than when to jump in. And if you don't adopt this mindset or this practice in the very beginning, I promise you the market is going to humble you, and you will adopt that of the caution of what, when are the conditions that are favorable for my strategy and my market edge to go in.